Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.
What are the impacts of the Federal Reserve monetary policy today on the financial system, and are there any permanent distortions that we'll be discussing with our next guest, Nomi Prins? She is a Wall Street insider. She has worked on Wall Street at Bear Stearns, Lehman Brothers, Goldman Sachs, Chase, for many, many years. And now she is an independent financial journalist and best-selling author and geopolitical expert. Welcome to the show, Nomi. I've heard all about you. I've read your work. Fantastic having you on Kitco. Welcome to VRIC.
Thank you so much, David.
We're going to start by talking about your upcoming book, Permanent Distortions, which I briefly alluded to in the opening. Now, this is a book that are you finished working on the book? Are you currently working on? But it is talking about the financial sector and the different, juxtapositions of Fed policy and reality. Give us a synopsis of this book.
Yeah, so I am finished with it, and it is going to be out in stores on October 11th, but it is available for pre-order everywhere right now. Right. So it's been produced. And Permanent Distortion, and I use the permanent really, really critically because it's such a key component of the distortion that we have right now between the financial markets and the real economy. Because since 2008, and then in a magnified way since 2020 in the pandemic, the Federal Reserve has led other central banks into this exercise of creating money out of nothing. And what that has done is it's inflated financial assets so much more quickly than the real economy has been able to keep up. And that's why the gap between those two things, money that's flown into financial assets, even though more recently there's some uncertainty, there's negativity there, but in general that deluge of money went there and not into the real economy, and so we have this gap or this permanent distortion between the two, and that has caused a lot of turmoil around the world, geopolitical turmoil, civil unrest, inequality, and also a change in where economies are going to be going in terms of sectors where there will be money flowing as a result of this distortion. I talk about all of that in the book.
So the disconnect between the real economy and the financial sector, that's caused geopolitical tensions around the world? How do those two link?
So it links because the financial markets had all of this help from the fabricated money that the Fed and other central banks have created. Central banks around the world have created $41 trillion worth of money from nothing. And effectively that money has been leveraged, it's gone through Wall Street, it's created a lot of new billionaires, and it's basically inflated the entire market system, and particularly financial paper assets, and not just those. But because all of that money has been created externally and it's gone into one area, it's not gone, and so there's a deficit in the real economy. And when there's economic tension for people in their daily lives, in between groups of people, in between countries, for countries that have been in a developing instead of developed stage, that have to take on debt to grow further, and now they have to repay that debt in dollars that have been inflated by these policies, the unrest this causes becomes a permanent manifestation of people in our lives, in our countries. 2019 was the year that we saw the most civil unrest and social uprisings of any other year until this year. And so one of the results was what was going on with the Fed and with the distortion between markets and the real economy before the pandemic. And since the pandemic, it's been magnified.
And you wrote this book mainly in response to Fed action since the pandemic, or are you talking about distortions going back even further in history?
That's a really good question, because I have talked about distortions further in history, and we have seen them for decades. I mean, since we went off the gold standard in 1970, and all sorts of other reasons that we have had this sort of disconnect and this ability for central banks to create money to basically support their currencies. But why it became permanent, yes, is definitely because of what I saw in the wake of the pandemic. Because at that point, when what the Fed did was double the size of its book in a very short period of time, meaning it basically created almost $5 trillion worth of money out of nothing. Now, there were reasons that money was needed. I mean, the economies were closed, but the money didn't go into those economies to stay. It went into some people's pockets, and it helped them persevere over a very rough time. But that's just a small, teeny part of the story. The bulk of the money was leveraged and went into the financial markets, which is why they raced so far ahead of the real economy so quickly. It's like inflating a big balloon. You basically fill it full of helium and it leaves. Whereas on the ground, you're stuck with being on the ground.
But why is it a permanent distortion? One could argue that, yes, asset prices have been inflated, but they'll fall back into equilibrium along with the rest of the economy. But are you suggesting that this inflation of asset prices is going to be permanent, or are you talking about the side effects of that distortion is going to be permanent? What exactly is permanent here?
That's a really good question too. The philosophy that no matter what happens in the economy and no matter what happens with the markets, there is unlimited potential for central banks to step in and fabricate an unlimited amount of money. That main fact that had been basically rubber stamped by what happened in the wake of the pandemic means that we are in a period where there is no turning back, where it is permanent, where there is a sort of an unmooring of how money gets produced and distributed in the real economy versus how it can get produced and how it gets distributed in the markets. And so this isn't just about whether the markets are going to be going up forever. You know, we've certainly seen pullbacks in the markets, but that idea, that philosophy, that ability of central banks to do what they have done to the magnitude they've been able to do it is a complete game changer.
Were you in the banking sector in '08?
I was a financial journalist in 2008. Okay. I was following all of that. In fact, I wrote a book called It Takes a Pillage, which came out in 2009. It was written very quickly in the wake of that, following all the money that the Fed, the Treasury Department, other central banks, currency swaps and relationships that were happening as a result of the financial crisis.
I've always wondered, we did have QE after the financial crisis, 4 rounds in fact, but the magnitude of quantitative easing back then was nowhere comparable to what we had in 2020. I wonder why the difference in scale was there, given that the '08 financial crisis was, I would say, arguably even more serious in terms of its impact on the financial sector at large. I mean, yes, COVID impacted the entire global economy. We had shutdowns, logistical supply chain issues, but we didn't have an entire collapse of the financial system. Yet the Fed didn't step in back then to the same degree that they had this time around. Why is that, do you think?
Well, what's interesting is it's all a question of timing and magnitude. And you're right, back then the Fed came in and it had a book going into the financial crisis period that was about 10 times smaller than it had going out after all the rounds of QE. So you're talking about $400 billion sort of on the edge. You know, there's always a little bit of buying going on of treasuries from the Fed to the Treasury Department. But what was going on is it basically increased to $4.5 trillion in those years of QE in the financial market. So you could argue that the acceleration was a 10-to-1 during those years. Now that then doubled, and so the absolute number of an extra $5 trillion in the 2020 period was absolutely more. Technically, the trajectory was only double versus 10 times, but it's still going in the same direction, and it still shows that there is no limitation when there's deemed to be a necessity to save things. And I believe that a lot of what was created was not just created to save the economy, because the reality is that the amount of money that flew into the markets and the liftoff that it provided financial markets was far greater than the absolute amount that people got on the ground in the economy.
Would you make the argument that the bull run we had in equities since '09 to basically now was due mostly because of Fed policy and easy monetary policy for the last decade and a half?
It was certainly elevated by that. I mean, we went into that period, and that was part of the reason for the policy to begin with. We went into that period in a situation where the banks, as we all know, were considered too big to fail. The fact that they got to be too big to fail happened for a number of reasons that came before that. One, mergers, one, buying their own shares, one, the relationships that some of the senior bankers had had for generations, decades, with Washington, and therefore creating policies that helped these banks and these financial institutions grow. So there was a lot of push into the market before the Federal Reserve came in and did the quantitative easing in the financial crisis. So we were already in a bull market with periods of sort of downturns, little corrections here and there. But that move of quantitative easing and rates becoming zero and money being so cheap, not just in the United States, but throughout the world, negative rates in Europe, 0% rates in Japan. But,
Right.
but collectively, the major countries in the world made sure, that's still the case today, that on average, money is at 0%. On average.
Okay, well, let's talk about present day. We have inflation at above 8%, which is the highest it's been since the 80s. Inflation is a big theme here at the conference at the VRIC. We have different schools of thought as to what has actually happened and caused this inflation. There's the monetary school of thought, which is that M2 has increased and inflation is a product of the increase in the money supply. And of course, we have people who may agree with Biden and Jerome Powell to some extent that the inflation we see today is caused by supply chain issues and logistical problems mainly. Which camp are you in?
I honestly think both of those things come into play.
Yeah.
It's not a question of camps per se to me. It's a question of following how money gets distributed into the markets and into the real economy. There is a reality of inflation in the real and for the real economy because of supply chain problems, which impact food, because of war in the Ukraine, which impacts oil, and real inflationary pressures that are a result of both of those two things, supply chain disruptions and other forms of geopolitical disruptions. That's a fact. And that's something that central banks shouldn't even pretend they can control, because that's when problems start happening. If Jerome Powell were to say, I can fix that, that would be a lie. But on the monetary policy side, the fact is, M2 has gone down. Has basically gone down in terms of increases. It's decelerated as we've increased rates.
The rate of pace.
It's still quite high, and so what tends to happen is right now we're in this period where inflation has spiked up, where there has been some adjustment upward in interest rates, and where there's just a lot of tension in the world. And as a result, if we look at this very small picture, it looks like what the Fed has done is basically raised rates, not impacted inflation, and sort of impacted money supply. But if we come back, we still see that the Fed has a $9 trillion book of assets underpinning the market. Inflation is still going to go up in real terms in the near future because of real reasons like supply and disruptions and unrest geopolitically. And unfortunately, that's why the markets are caught in this uncertainty as to what happens. And what the markets most would like is for the Fed to just say, you know what we are doing is starting to constrict movement in the economy. It's starting to run the risk of creating a more recessionary sort of path in the economy. So we're going to sort of dial back some of our hawkish stance. That's not going to happen in the next 1 or 2 or maybe even 3 Fed meetings. But I believe it's going to happen because the Fed's going to be caught in the same political quagmire it's been caught in now, which is now it had to act to do something about inflation. It's going to have to act to do something to stop the economy from slowing down. And we're in the vortex of those two sort of realities, and that's why the markets are so freaked out right now. And we've seen just money coming out and kind of waiting to figure out what to do.
I've heard you make those remarks at one of the panels here at the VRIC. It's interesting you say that. Just yesterday, Jerome Powell made the statement that he wouldn't mind, I'm paraphrasing here, but he wouldn't mind raising rates above neutral. That's all bluster.
I think he wants to raise rates to show that he's basically doing what he said he would do. And again, there will be some movement in rates upward.
Sure.
But it is bluster to the extent that I think what he would really like at this point is for inflation to come down, for him to be able to take credit, and for the market to go back up.
Put it this way, if the Fed did nothing at all, no rate hikes, nothing, would inflation naturally come down anyway?
I think inflation, that depends on supply chains and disruption in the world and everything else. Again, the Fed can't create food. The Fed can't create oil. The Fed can't create green metals.
They could create inflation, which would bring up the food price, which would make people hungry.
Exactly, which would make people hungry, create more inequality, make them start to default on loan payments, and other things that hurt an individual, a sort of normal person walking around their normal life more harshly.
Okay.
Than it would hurt Wall Street just taking money out of the market right now and probably waiting for an opportunity to put it back.
Right. Okay, so everyone's wanting to know what the impact of Fed policy is today. Let's just assume that they're going to carry out what they said they're going to carry out, which is, I think, several more rate hikes this year. By the way, some argue that's not even enough, because if you look back at the 80s, Volcker raised rates to double digits when inflation was double digits. We got 8%, 2% is not enough. But let's assume they go back up to 2.5%. What is that going to do to financial markets? What is that going to do to all these other social factors that you talked about?
I think going up to 2% is going to basically put us back to where we were before the middle of 2019, when the Fed effectively started going back downward on rates. So we had a period of raising rates, or basically going back on quantitative easing or tightening. The Fed did let some balance roll off its books. We got down from a $4.5 trillion amount to $3.7 trillion in August of 2019, and then it creeped back up because the Fed went back to being sort of dovish and basically fabricating more money to put into buying securities from the banks, basically because they were noticing that their companies, their corporate clients, were struggling. And I think that can happen again. So if rates were to rise to 2 or 2.5%, I think that the book of Fed assets might not shrink as much as he is telegraphing. So there will still be this sort of cushion for the markets. And I think what the markets really want is some sort of certainty on what he's going to do. So the moment, and I do still believe he's going to raise rates over the next 1 or 2 or 3 meetings, but the moment where the language becomes more dovish, or the size of the rate hike becomes lower, or it stops, that's the moment where I think a lot of this uncertainty comes, sort of goes away, and the markets realize that they have actually a pretty good deal right now with respect to the cost of money.
Do you think that equities will continue to fall?
Again, I think right now in the next couple of months, and I would say over the next at least 1 or 2 Fed meetings, equities are going to be very volatile. They have been falling. We also have seen very crazy updates. We've seen a lot of volatility to the downside, but we've basically seen a lot of chop and a lot of volatility in the markets, and that is based on uncertainty. The headlines say it's based on inflation, because I think that's an easier headline. You know, people understand or think they understand inflation because, like, they feel it every single day. So it does carry some, bigger banner. But the reality is, once the markets have a little bit more certainty as to when rate hiking is going to stop, or QE is going to start, or quantitative tightening is going to stop, I think that's when you see the markets rebound.
Maybe we need a recession. Maybe that's when the Fed is going to start tapering back on their hikes and actually go back into QE mode again. Maybe bad news is good news for the markets. What do you think?
I think that's an unfortunate possibility of the markets, that the extent, and this is the whole thing, that really what the markets want is cheap money. Everything else, every other headline just doesn't matter. So if there is a recession, or if they believe that the Fed thinks there's a recession, so this is a little bit of a chicken and egg kind of situation. That is positive for the markets, because all the markets really, really want is cheap money.
Well, put the Fed aside and monetary policy aside. Let's go back to the real economy, which is something you talk about in your book. Is the real economy right now and going into the foreseeable future going to be strong enough to support equity markets and present just naturally another bull cycle?
I don't think the real economy itself as a whole is, and that's part of why I think we're in a permanent distortion. I think the markets really, really need external sources of help, whether that is cheap money, leveraging cheap money, or whatever that looks like globally. But that said, in the real economy, there are sectors that we will see growth in. I think there's going to be more of a selective nature because of that, to where the money goes back into the markets when there is more certainty as to that monetary policy.
Let's talk about investment implications. Now, you mentioned to me offline you like the commodity space. What sectors in the commodity space do you like, and why?
I very much like anything that touches the green energy, the new energy space, and also to an extent infrastructure. And there's a couple reasons for that, because even with inflation, there are multiple sources of funds that are going into these sectors for different reasons. So I watch the flow of money. So if we look at the new energy sector, we have had $550 billion of allocation through the latest infrastructure bill, bipartisan passed infrastructure bill in the United States, for example, of which a significant portion of money is going towards infrastructure in electric grids. $70 billion is going into EVs in particular. There's a portion going into electric batteries and lithium type of batteries that have that green sustainable component to them. So that's government money. It's the same thing in Canada. It's the same thing in Europe. There's government funding out of all of this that is flowing into a transformation in the new energy space. As a result, there's Wall Street money. As a result, there are funds. As a result, retail investors will follow. And connecting it to the real economy in this particular space, people have seen really, really high gas prices. And the demand for electric vehicles and electrifying utility bills at home and finding other renewable energy sources that are cheaper than what they're working with right now is something that no matter what people think about the space, want to be considering. Conversations about electric vehicles, which used to be just about Elon Musk being crazy, are very, very real at everyone's table, no matter what they think of the climate, the environment, the cars. Because they are noticing that their gas bills to fill up their cars are really, really high. So there's a demand drive. There's a lack of supply in the commodity space, in lithium, in nickel, in cobalt, and so forth. And I think that's why these types of commodities are going to continue to appreciate, because there is just simply lack of demand. And money is going to continue to flow into the mining elements and the exploration of places that can produce those elements because the demand is there. And that's kind of regardless of what the market's doing. They're going to basically be a future path towards a total energy transformation. So I look at all of those things. Metals that have use value in infrastructure, metals that have use value in the green energy transformation.
Don't you think that would take a long time for that thesis to take effect, given that infrastructure does take a while to be built?
It takes a long time. It will take time for it to come to fruition. But the path is very, very directly up, again, because we have multiple flows of funds. Yes. We have the government, we have retail, we have need, we have Wall Street. We have multiple forms of funds and funding to these areas. It doesn't mean every single exploration, for a new spot of graphite or something is going to come to fruition, or that it isn't going to take time. But it means that the demand is all in the same direction.
You're very much an expert on all things finance. I'm just curious, we have a couple minutes left. I'm just curious as to why you left Wall Street, having been at leadership positions in some of the top banks in the world. Your career was already very well established. You were very successful on Wall Street. Why did you leave?
I left because after a decade and a half on Wall Street, leading into the Enron scandal, the WorldCom scandals, and just a massive amount of corruption on Wall Street, and not that Wall Street's the sort of angel of whiteness in general in finance, but the fact is that I got into a point in my career where I was just seeing too much that was getting too ugly, and I just didn't want to be a part of that. To me, when I was on Wall Street, my responsibility was also to our clients, the clients of whichever bank I was working at. And there started to be a turn towards the responsibility needing to be more focused on the company, and that was at an adverse kind of side to clients. So I felt there was just a lot of that was happening too quickly, and I just didn't like what Wall Street was doing. I didn't like the practices. I didn't like the risk management practices that were going on, and I talked a lot about that in my internal roles. But a lot of shady stuff was going on, and I just really did not want to be a part of it anymore. And at the time that I left, which was just after 9/11, actually, it was a while back now, I chose to take the path of basically sharing that information and continuing to watch it, continuing to analyze it, write about it, speak about it with people around the world. So to me, it's been more fulfilling than sort of banking those paychecks on Wall Street and keeping my mouth shut.
I'm just curious as to how you think, final point, I'll let you go. I'm curious as to how you think the future of finance is going to progress. There's talk of DeFi, decentralized finance, and crypto banks potentially replacing traditional financial systems. I've been at many crypto, this is not a crypto conference, but I was at crypto conferences where we had people like yourself who were ex-MDs of Goldman or JP Morgan, now working for a crypto bank, heads of blockchain companies. And they really believe this is the future. They really believe that decentralized finance is going to reshape financial institutions and change the way we bank. Is this a space you've observed at all?
I do think decentralized finance is a wave of the future. I think that, well, it's a wave of the present too, actually. I think that Wall Street banks are going to continue to invest in DeFi so that they can basically hedge themselves. So this is not like they're going down without a fight. But the idea of direct investment, being outside of the main banking system, the reaction in general to what happened in the financial crisis of 2008, I don't think it's an accident of history that Bitcoin sort of became even remotely popular. Obviously, there's people on both sides of that, but the point that it sort of became anything in the wake of 2008, because the technology behind Bitcoin, the computer programming behind Bitcoin in different incarnations was around for decades before that. It was just sort of what happened at the time was, all right, well, this is a moment. But decentralized finance, or really what I consider it to be more independent finance between individuals, countries, companies, and countries, to the extent that it's regulated, I think, properly, I do believe it needs regulation of some kind. But I do think that's a wave of the future.
Well, wealth inequality is something you've written about extensively. Do you think DeFi and cryptocurrencies, suppose that everybody in the world, just suppose everybody in the world has access to some sort of capital, most of the world is underbanked or unbanked, suppose DeFi does what it's intended to do, which is provide capital to everybody, what is that going to do to wealth equality? Is that going to actually widen the wealth gap or shrink it and make everyone more equal?
I think it can help shrink the wealth gap. Now, that said, the investors in Bitcoin tend to be more wealthy that own more Bitcoin. I mean, that's just sort of what has happened. And of course, there have been individuals who have had basically no money, who have invested a little bit of that money or little money into Bitcoin and become wealthy as well. And of course, we see the volatility and the swings, which is a component of something that's this new at this stage. But I think in the limit, people having access to a fair way of banking, a quick way of banking, a less fee-intense way of banking, and a way of connecting across to each other without a lot of sort of currency and fee barriers and everything else along the way, is something that's potentially powerful to help reduce that money inequality amongst people.
Well, definitely in a space to keep eyes on. Nomi, thank you so much for your time. You've definitely shed light on a lot of different topical issues. Good luck with your book launch in October, and welcome to Kitco.
Thank you so much, David.
And thank you for watching Kitco News. I'm David Lin.
Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.